Well, welcome to our High Rock clients and any other listeners on this rather gray Tuesday afternoon in Toronto. And thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategy. So sit back, relax, and perhaps grab a glass of wine. We're recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague, Paul Tepsich, the founder of High Rock. Our financial planner, Bianca Tomlinson, is also on the call, and we'll have a question and answer period at the end of the call. So if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Well, what's happened since our last webinar? Well, as we do each week, let's check in on the top trending Google searches in Canada. And the first one from last Wednesday is the San Bernardino shootings. That was followed by the new Batman vs. Superman movie and the death of musician Scott Weiland, Ryan Gosling on Saturday Night Live, BC Hydro on the back of storms that left the southern coast of BC and 40,000 homes without power, and then, of course, this idiot. No further comments on him. But Google searchers continue to show no interest in financial markets, so let us help fill in what's happened since last Tuesday and get a sense of what is yet to come and what we are doing with our models to get the best risk-adjusted returns. There's lots to cover this week. Well, U.S. bond markets were slightly weaker on the week, and Canadian bond markets were basically unchanged. There's lots of happening, and we'll cover it a little further along in the webinar, but bond market volatility jumped significantly as the European Central Bank did not add as much monetary stimulus as expected, and U.S. employment data was stronger than expected. Meanwhile, high-yield bonds weakened, but it was preferred shares that were hit hardest as banks used the recent upturn in preferred share prices to issue more fixed-rate reset preferred shares to raise their capital needs. Interestingly, our research suggested that there would be likely be more issuance of preferred shares by banks, so we used the recent bout of buying to take more sales and further reduce our exposure. As for the 10-year yields, U.S. yields rose by 6 basis points on the week, while Canadian yields were little changed, further widening the spread between them to 71 basis points. This can pretty much be linked to the stronger U.S. employment data and weaker Canadian employment data that we saw last Friday. Now, the Fed is expected to raise rates, while the Bank of Canada is not. In fact, the Bank of Canada today was discussing what new tools they would utilize if they needed to in the sake of any further future financial meltdowns. Our benchmark world equity index was was weaker by about 2.5% this week. The Euro Stoxx 50 dropped by 5.25%, and Germany's Xetra DAX index and the TSX were down similar amounts. The best performer on the week was the Chinese the Shanghai Composite, basically flat on the week. Well, last week we suggested that the narrowing pennant chart pattern in the all-country world index would likely force a breakout one way or the other. Well, at the time, sorry, I'm a little ahead of myself there. At that time, the market was testing the downtrend line, the upper bound. As of today, it appears that the selling pressure has increased, pushing prices through the uptrend line, but finding some temporary buying support again at our first support near 56.50. If selling continues, then we could see further weakness to test the next support near 52.5. That's about 10% lower than where we are right now. Well, it was expected OPEC would roll over its policy as a result of the disunity among member states, but in a rare move, the group failed to produce a figure for its formal production ceiling, signaling to the oil market the extent of the division. Oil prices plummeted, recording new lows today, almost back to the lows of 2008. As a result, the Bloomberg Commodity Index is testing its multi-year lows as well. With oil moving lower, the Canadian dollar hit new multi-year lows near the 73.5 cents per U.S. dollar level. These are levels not seen since 2004. And volatility has jumped to above its long-term averages. Now, the World Equity Index is comprised of about 52% of U.S. companies, so we keep a close eye on what is happening in the U.S. economy. And while we wait for the U.S. Fed to meet next week and announce their next monetary policy moves on Wednesday, we closely watch the economic data that might give financial markets some indication of what direction they may take. Fed governors have been quite vocal in recent speeches, preparing the markets for a likely liftoff of 0.25%, and bond markets have built in an over 80% chance of this happening now. Now, equity market participants were rather thrilled on Friday by stronger than expected employment data and upward revisions to previous month's data, despite the fact that these are lagging and at best coincident indicators of economic strength. It will certainly allow the Fed to finally meet their goal of raising rates in 2015 at next week's meeting, as they've been preparing markets for. Interestingly, however, the longer-term trend looks less than healthy. Now, we showed this chart of the manufacturing index last week, but it does look eerily familiar to the trend in employment. And the same for small business optimism, which numbers which were released this morning. And of course, the Atlanta Fed GDP Now forecast that we showed last week also mirrors those two indicators. So the Fed, who appears to be the most optimistic institution currently in the United States, will likely be tightening monetary policy at a time when leading economic indicators point to further slowing in future economic growth. This may not necessarily be a good combination. Well, around the rest of the world, Euro area companies represent about 16% of the World Equity Index. On Thursday of last week, the European Central Bank announced further monetary stimulus. However, it was less than had been anticipated. Now, both stock and bond markets did not like that. The European Central Bank left its benchmark refinancing rate unchanged at a record low 0.05% on December 3rd, but lowered the deposit facility by 10 basis points to a minus 0.3%. Now, it had been widely anticipated that this would be a move to minus 0.4%. Today, we saw data that showed the Eurozone economy advance at a slower 0.3% on quarter in the 3 months to September of 2015, compared to a 0.4% expansion in the previous period and the lowest performance in a year. Household consumption was the main driver of growth, while offsetting a negative impact from external trade. Well, Japanese companies represent 8% of the World Equity Index. We saw the GDP in Japan actually advance 0.3% on the quarter in the 3 months to September of 2015, compared to an initial estimate of 0.2% contraction. That beat forecasts that expected a reading closer to flat. Final figures showed that capital expenditure increased while inventory shrank less than expected. In other words, technically, Japan did not enter a recession as had been initially indicated. Companies in the UK represent 7% of the global equity index, and the British economy advanced 2.3% year on year in the 3 months to September 2015, slowing from a 2.4% expansion in the previous period and in line with preliminary estimates. The second release confirmed the economy posted the worst performance since the third quarter of 2013, as imports grew faster than exports, bringing net external trade contribution into negative territory. While Chinese companies represent 2.5% of the world equity index, today the China trade surplus was announced at 54.10 billion US dollars, and that was for November. That was down from 54.5 billion surplus reported a year earlier and below the market consensus. Imports fell more than exports. Exports declined by 6.8% on a year-to-year basis, the fifth straight month of fall, and imports dropped 8.7% on a year-to-year basis, following an 18.8% decline in October. It is the 13th straight month of contraction as a result of declining commodity prices and weak demand. Well, in Canada, where companies represent 3% of the world index, last week the Bank of Canada left interest rates unchanged, as was expected. The Canadian economy lost 35.7 thousand jobs in November. Part-time employment actually declined by 72.3 thousand, while full-time employment added 36.6 thousand. Canadian jobless rate increased to 7.1% in November from 7.0% in October. This was higher than the market had expected. Well, Federal Finance Minister Bill Morneau confirmed Monday that the contribution limit on the tax-free savings account will drop back to $5,500 from $10,000 effective January 1st of 2016, but that the limit for 2015 will remain untouched. Mr. Morneau also announced that contributions will be indexed to inflation as of next year. The Conservative government increased the annual contribution limit to $10,000 for $5,500 in the 2015 budget, but that increase has now been reversed going forward. The TFSA currently provides up to $41,000 of cumulative contribution room to allow investment income to grow tax-free. The rollback to $5,500 in contribution room was not unexpected, but an Angus Reid poll during the election campaign suggested that 65% of Canadians were actually opposed to this. Well, last week we had a question regarding the Canadian housing market from one of our listeners. A recent Reuters poll found Canada's housing market is likely to be a drag on economic growth over the next couple of years, thanks to too much supply and high levels of household debt, making further buying a risky affair. Analysts suggest property will no longer be able to do the heavy lifting for Canada's economy, as many new households stretching themselves to buy expensive property have become deeply indebted. Housing turnover has also slowed. The slowdown has been particularly sharp in Alberta, where much of Canada's oil exports are produced, which has been hardest hit by the collapse in the price of crude. A slight majority of analysts in the Reuters poll, 13 out of 21, anticipated the housing market would be a drag on the economy in the coming years, compared with 8 who expected it to be a net contributor. So that's reasonably close. House price inflation is expected to slow to 2% and 1.5% in 2016 and 2017, respectively. Just 1/3 of the economists polled forecast a correction by 2017. After the Bank of Canada cut interest rates twice this year to soften the blow of the oil price shock, house prices have risen further, especially in Toronto and Vancouver. Home prices have nearly doubled over the past decade, while the household debt-to-income ratio has reached a record high of 165% by the end of June. The Bank of Canada has acknowledged high household debt is a vulnerability for Canada's financial system and estimates that the housing market could be overvalued by as much as 30%. Now, while house prices in the U.S. have been recovering for years after an historic correction, in Canada they have surpassed affordability limits on the average Canadian home buyer, particularly for regular homes. There are still vast numbers of condominiums being built, particularly in Toronto and Vancouver. However, a majority of analysts said the recently elected Liberal government will not take any action to cool down the housing market. Home building in Canada is forecast to remain robust over the next year and average around 180,000 units. With the U.S. Federal Reserve widely expected to hike rates at its last policy meeting of the year next week. It could take Canadian mortgage rates higher. Regionally and locally, markets will be driven by supply and demand. At the moment, foreign demand in Vancouver and Toronto is driving prices. The big question is, will current demand survive the ongoing global economic slowdown? Further, will over-leveraged homeowners be able to meet debt servicing requirements if they see either a reduction in their employment and or see rising interest rates? At the moment, that is the wild card. Alberta's housing market is currently suffering from reduced employment opportunities, falling demand, and rising supply. Whether that will translate to the rest of Canada certainly remains to be seen. All right, so what do we see coming on the horizon? Well, let's go to the bond markets because they tend to lead other financial markets, and normally we check in with them. Lots of bond market volatility this past week as the European Central Bank was less aggressive with their monetary policy stimulus. German bond yields jumped higher from 3 years out to 15 years. Negative yields now only go out to 5 years. Last week, negative yields went out to 7 years. The U.S. yield curve continued to flatten as the employment data indicated that a Fed rate hike was now higher than 80% likely. Higher short-term yields, but in the longer term, the yields have actually come down. Well, there continues to be a wide divergence between high-yield bond prices and the S&P 500. Historically, high-yield bonds lead equities, but usually move well in advance of the equity markets. Early this year, high yield began to turn lower, and equity markets followed in August. Now, however, the S&P 500 tried to rebound at the end of November, but has been unable as the proverbial elastic band seems to be snapping back. High-yield bond defaults are rising. Historically, this has been followed in the past by recessions. This is something we certainly need to monitor very closely. Well, this is no surprise. We still remain convinced that equity markets are expensive, although they have begun to get a bit cheaper over the last week. For the fourth quarter of 2015, companies are expected to report year-over-year declines in both earnings at negative 4.3% and revenues at minus 3%. However, analysts do currently project earnings growth and revenue growth to return in 2016, starting in the first quarter. Analysts are expecting earnings growth in the first quarter of 2% and revenue growth of 2.9%. For all of 2015, analysts are projecting earnings to be a negative 0.5% and revenues to be a negative 3.3% in a year-over-year. For all of 2016, analysts are now projecting earnings to rise at a clip of 8.1% and revenues to rise at a clip of 4.4%. The other metric that we like to look at, enterprise value to earnings, the S&P 500 companies are continuing to be valued at an expensive 12.75 times. The 10-year average is 10.9 times. And as we've mentioned on many of our previous calls, in our tactical growth model, we are not much interested in anything that is more expensive than 8.5 times. So again, we're looking for value in that particular model. Margin debt, where investors and traders are borrowing to buy equities, is another indicator of the health of a stock market. In 2007, margin borrowing turned lower and was followed by the S&P 500. Margin debt turned lower in May, and that has raised warning flags for us. We continue to monitor that, and we'll keep you appraised as we go forward. Well, last week we introduced a new indicator of the health of stock markets. When the spread between large cap markets like the S&P 500 widen over small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered to be unhealthy. As you can see from this chart, that is currently the case, increasing the risk of a significant market correction to come in the not too distant future. So what does it all mean? Well, as I suggested on BNN The Close with Michael Hainsworth a few weeks back, I did not foresee a Santa Claus rally for equity markets based on many of the signals that we've been seeing. Weak economic activity globally, negative earnings growth, failing credit markets, and an unhealthy market breadth, as well as a diverging monetary policy between the European Central Bank and the U.S. Federal Reserve. Now, I'm going to be back on that show on December 16th, which is next Wednesday at 4 p.m., and that happens to coincide with Fed Decision Day. So try to tune in to see if I have to talk my way out of a tight spot or not. Well, our discipline at all times is to protect our clients' capital, and especially so when we see the warning signs. We are not alone in this thinking. Cash and cash equivalents are important defensive assets, and we cannot stress this enough. So we are carrying greater than normal cash balances in our models and waiting for asset prices to get to more reasonable price points before we begin to commit capital for the long term. So let's look at our models. We had another question from a listener last week who wanted to see how our current models appeared. These are our approximate current targets. Now, for fixed income, the bulk of the model, 60% approximately, is comprised of safe government and investment grade bonds. The balance is made up of a combination of preferred shares and high yield bonds. Now, I will stress these are our targets. At the moment, we are still carrying considerable cash balances in that fixed income model in lieu of preferred shares and in some cases high yield bonds. Now, in the global equity model, U.S. companies are approximately a third, international outside of North America approximately a third, and at the moment, cash is about a little under 25%. As you can see, we're overweight cash and underweight the more expensive U.S. equity market. A client portfolio will depend on their wealth forecast, their goals, their risk tolerance, and time horizon to determine what percent of each of these models they will have in their portfolio. For example, my portfolio specifically is 40% of the fixed income model, 50% of the global equity model, and 10% of the tactical equity model. All right, let's talk about what we're looking for next week. On Thursday, actually, this is 2 days from now, we will see the UK interest rate decision. On Friday of this week, U.S. November retail sales. Widely watched to see what the end of November holiday buying period was all about. On Saturday, we'll see some more numbers from China, November industrial production. On Sunday, we'll get Japanese industrial production, followed on Monday by the Euro area industrial production. So a big week to see what's going on in the industrial world around the globe. On Tuesday, we'll see UK November inflation as well as US November consumer price index. And then as well on Tuesday, we get the start of a 2-day US Federal Open Market Committee meeting, at which time on Wednesday, of course, they will let us know their decision on interest rates. Well, that's it for today's discussion. If anyone might have a question, please feel free to ask it now. Well, if you do have questions and wish to email us, we would be more than happy to get for you to send them. We would also love to get feedback on our webinars. We certainly would like to know what you think, what you like, what you don't like, and what you might like to see us cover that we're not. But that's it for another week. I want to thank you all for taking the time to tune in. Have a great rest of the week, a wonderful weekend, and we'll be back with another report next Tuesday. And by the way, that will be our last webinar of 2015. Well, this is Scott Tomlinson signing off.